telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like-kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Hello, everybody, and welcome to another Capital Gains Tax Solutions Mastermind on the Deferred Sales Trust. Excited for you to be here. We are recording Easter weekend. It's Friday, 4/15, and we believe that most high net worth individuals and those who help them, they really struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy. And using a proven tax deferral strategy such as the Deferred Sales Trust is the best way, or one of the best ways, if not the best way, to exit highly appreciated assets, so you can exit like a millionaire and you can unlock the transformational wealth planning that this gives to you. We're in a state of more of tax flow versus just cash flow, and it's now more important than ever to have a plan and to have a team of professionals to help you execute the plan, to keep more of your hard-working dollars in your pocket and invest it so that it can grow the economy, create more jobs, do a bunch of good for a lot of people, and maybe even give it away and to charitable causes that you believe in. All tax deferred. For those who don't know me, my name is Brett Swarts, and I'm the founder of Capital Gains Tax Solutions. And we host a podcast. Obviously, we have a YouTube channel if you're watching this on YouTube. And we help individuals every single week decipher whether or not the Deferred Sales Trust is a good fit or not. And then we invite everybody to this mastermind. It's kind of like Deferred Sales Trust University, where we open up the playbook and we share the actual deals that are closing so that we can help you overcome any false beliefs of, is this too good to be true? My CPA never heard about it. Is it worth it for me? Does it work in this situation? There's so much that's not out there, and we want to make the Deferred Sales Trust simple for you right now. And I don't just do this alone. I have some amazing strategic alliances, some amazing business partners, and some amazing clients that also come on. And then you, maybe the person learning about this for the first time, we welcome you. So if you could do me a favor, if you could type in the chat where you're from, what's your expertise, maybe you're helping high net worth individuals. Maybe you are a high net worth individual yourself. We want to you can be your first name and where you're from. And then also, if you're watching this on Facebook, do the same thing. That helps to increase the algorithm, if you will, so that more people can learn about this. And I want to introduce you to somebody who is a dear friend of mine, as well as an expert. They say to get into the room with people that are smarter than you so you can become smarter. And I really believe that this gentleman is one of the smartest persons I've ever met. He's a financial advisor. I call him the CPA whisperer. He's brilliant. Please welcome my co-host, one of my business partners, Jake Miller. Jake, how you doing?
Doing very well, Brett. Thank you so much for that great introduction. Happy to be here and excited about this mission of ours to help more people learn about the Deferred Sales Trust.
And give us a little bit more about the vision. I talked about it a little bit, but how's the vision in your words, Jake?
Absolutely. Anybody that has a highly appreciated capital asset, something that shows up on your balance sheet, you go to sell that capital asset, whether it be crypto, whether it be intellectual property, a patent, copyright. If you're an artist, it could be a song title, it could be a catalog, or real estate. Any of these assets that have highly appreciated over a short period of time, long period of time, if you're going to sell those and you're hesitant because of the tax ramification or the pain of the tax is just so great that you'd like to see what other options are out there, then the Deferred Sales Trust may be a good fit for you. We like to help those individuals defer the recognition of that transaction so that they don't have to pay those taxes today. They can continue to reinvest the gross proceeds of that sale rather than net proceeds after divvying it out amongst the various taxing entities.
And how much is that usually? Like if you sell something, Jake, like depending on what state you're in, of course, but generally speaking, you say you bought something for $1 million and it's worth $3 million, you got about a $2 million gain. What's the percentage on that gain? Like how much is going to be taxed? Like what is that number typically?
Yeah, so the most favorable outcome of that might be around, let's say $400,000 or 20% for the capital gains tax rate. Then tack on another 3.8% for the Obama tax. And then of course it depends on your state. If you're in Florida, then that, you're okay. That's pretty good. If you're in other states, such as California, which does not recognize a more favorable tax rate for capital gains, then you're subject to the state tax rate, which, Brett, you're in California. What's that rate?
It's 13.3, and it's brutal, right? And I call it Taxofornia because, we grew up and we kind of just become immune, not immune to it, but it's like the frog that sits in the water, the boiling water. Like it's just, you kind of just used to it. But you look around and you go, wow, this isn't, Puerto Rico or Nevada or Texas or Florida or these tax-friendly states like Wyoming. Like, wow, like there's something that's different out there, which also goes, well, maybe there's different strategies to solve this problem, right? And I always say, Jake, that the bigger the pain, the bigger the motivation to actually overcome that pain, right? It's pretty common sense. But you got to really look at those numbers because they're substantial. And some people get confused. They go, well, I'm at a lower tax bracket, Jake. I may have this cryptocurrency that's worth $3 million, but I'm only making $50,000 a year. Don't I just stay in that 15% bracket? Could you dispel that myth for us right now?
Yes, and so you don't. In fact, the sale of a capital asset changes your AGI. That's going to change your tax ramification across all other income that you've had during that year. And so it's not just the sale and recognition of the sale of this one asset or this one transaction or series of transactions you're going to have this year, but all the other income combined that you're going to earn, it all jumps up into higher brackets. And, through proper planning and proper structuring, getting in front of a deal before it happens. I mean, sometimes an opportunity comes along, you want to take advantage of it, right? But you might actually end up with more at the end of the day with a little bit of planning, such as what Brett and I help people do with a deferred sales trust.
Yeah, by the way, it's not unlike what you already maybe have done, like an IRA or a 401k, where you're looking at ways to defer tax on retirement income, right? And so, or even current income that you have now in lieu of having some retirement income. Also, a 1031 exchange, likewise, you can defer the capital gains tax if you follow the rules. And the government gives these things so that it incentivizes us to do more transactions, to sell, to transact businesses, cryptocurrency, to exit one asset hopefully go into another that spurs more economic growth for them. So there's reasons why they do this. They can't force Jake or Brett or you to sell your asset, at a highly appreciated. They can encourage you through tax, right? That's the way they do it. Tax incentives. That's also part of why if you build or own or manage multifamily properties, or you need to own them, you can depreciate them, and that enables you to have more cash flow, not only to improve the property, but maybe to build more assets, because guess what? We're in a housing crisis, so they can't force us people to be contractors, but they can incentivize people who are contractors or people who want to provide housing to do that in a way that benefits society. So these are all things that are here. Now, you do want to make sure you follow the rules, right? And that's very careful. That's very important, because if you don't, you can get in trouble, which leads us into the deal close story of the week. But before I go to that, actually, I want to just touch on for those who are tuning in for the first time with cryptocurrency. Jake, would you just give us the 60-second Bitcoin sale that we helped our client out with, so people can know what's actually real and possible?
Exactly. All right. So had a client, wonderful, wonderful lady, very kind and giving individual who put $50,000 away into Bitcoin back when it was just kind of a new thing. That 50,000 turned into 50 million, which was kind of a wonderful thing. During that time, she decided to liquidate 5 million of the 50 million. We helped her with a deferred sales trust. She was able to liquidate and sell out of her position of the Bitcoin when it was high. And we invested in the market 1 million of the 5, and we took the other 4 and did something rather unique. We did that because she fully expected to pay taxes on all of this. She was afraid of paying taxes on the entire 50 million. We showed her that through the deferred sales trust, she can defer the timing of when she needs to pay those taxes, and that she can do more with it now. And she did. She invested 4 of that 5 million in a friend's company. And it's a tech company. It's an application for children in India to learn, helps them, and it's going really big right now. So this is great. She was able to do something she never thought she'd be able to do, because she just didn't have, she expected to pay a lot of money in taxes. And so she used that tax money. Instead of having to pay it today, she invested in a company, and now that company is doing good for the world as well as producing dividends. So all very exciting. It can be done. Crypto is can be a highly appreciated asset, and it does work with the DST.
Yeah, and by the way, she sold it at $54,000 a coin, right? 5 million at 54,000 a coin, and then it went up to about 68,000. Then it dropped down to 35. So for that 5 million, she's able to diversify, which is really a powerful component of the deferred sales trust. In other words, you don't have to invest all of the funds back into crypto, like a like-kind 1031 exchange. You don't have to put it all into real estate. You don't have to put it all into securities. You don't have to put it all into a business venture. In fact, you can do all of those. You can mix and match and dollar cost average. Now for her, being able to diversify unlocked a number of things for herself and her business partner, which was a startup seed capital for the business, as well as she can retire from her old job, working for a big tech company, and kind of build her and her business partner's dream with what they're doing. And so that's a cool thing. Now Bitcoin's working its way back up. We'll see. We did have another target of about 60,000 for another million or plus to come out. So we'll see where that goes in the future. But for those who are tuning in, that is kind of the cryptocurrency deal close story that we've done. We've done another one for Ethereum that was a $100,000 purchase that went to as high as $13 million. They exited $7.5 million, which was great. And they're looking at exiting more in the future as well. And then we have, I think, about 20 in the pipeline right now that are all kind of ready to go, and then things kind of dropped, and so working their way back up. But in the meantime, let's talk about the actual deal close story of the week that happened last week. And it's out of a great place. They say it's the most wonderful city maybe in the country. Jake, what do you think what city might be?
Oh my goodness, Brett. I don't know. I mean, that's based on popular opinion.
Guess. Well, it's sunny. It's southern. It's beautiful. It's on the West Coast. What do you think?
Yeah.
Okay, it's San Diego. Okay, San Diego, everybody. San Diego. Now, had a cool opportunity to spend some time together in college. Amazing place. In fact, my wife and family are going to be traveling down there next week for a big trip. Really cool. Anyway, so these partners in a property and a commercial real estate property are looking to sell, and they're looking to pay a big tax, and they're selling for around $12.5 million. Okay, and they say, oh my goodness, like we don't want to pay the tax, and we don't want a 1031 exchange. And they found us on YouTube. I think it was literally 21 days ago. Okay. That or they heard me on a podcast, one of the two, I'm not quite sure. But they saw us online. They started to dig into these videos, and like most things, we get a call. We're going to close quickly. Can you guys perform? And I say, well, it all depends. It all depends on the sale. It all depends on the contracts. It all depends on a lot of things. We like to say we want to do an x-ray of the deal. We want to determine if the deal, first of all, is eligible. What is eligibility? Well, 1 million net proceeds, $1 million gain. Okay. They had that. Number two is an LLC, S Corp, C Corp partnership. Yep, it was that. So they had that, or it could be individual as well. Number three, do we have the contract some time where there's still some contingencies remaining, which there was, so that's good. So all of like the actual practical things were there. Now it became well, can we trust these guys, right? And do we trust where the funds are going? And how do we know it's safe? How do we know it's protected? And that's where we put them in touch with the bank. We put them in touch, of course, with the tax attorneys, and we put them in touch with our client references. Our clients were amazing. They took calls and they responded. And we did it. We just closed it. I just closed it on officially on Monday. So it's actually this week. And it's cool. I'll be driving down there. I have never met him in person. We've only been on calls, but we'll get to meet him. I'll get to meet him in person. We'll stay at the Hotel Coronado, and we'll be meeting in person for the first time. But what's so cool about all of this that I really love is now I have a chance to serve their multiple families, because it was two brothers and then another friend. Actually, and one of the partners decided not to do the Deferred Sales Trust. He decided just to pay his tax, which is cool, because in the Deferred Sales Trust, we don't have to have all the entities moving. In fact, each partner can have their own trust and decide to go their own separate way. One of them decided to just pay his tax, which was fine. The other three decided, hey, we don't want to pay our tax. And so that is the deal close story of the week. Jake, any thoughts or feedback on what I just said?
Yeah, so I was cutting out of reception a little bit. Which town did you say is this?
It was San Diego. San Diego.
San Diego. I should have known. Anyway, very nice. So one thing to really focus on there, like you mentioned, is the fact that with a 1031, if that's what they would have chosen, all the partners would have had to have done the same thing. So that's definitely, a degree of flexibility with the Deferred Sales Trust, that they, it's based on household, not on partnership status, not on how things were before. And that not only can you reinvest in other assets and diversify, but each household can make their own choice on what to do.
Exactly. And so that is the deal close story of the week. Now we're moving into open questions for everybody. Okay, it could be questions, it could be comments, it could be concerns, it could be anything. Okay, so I'm going to open it up for anyone to ask Jake or me any questions and to discuss. It could be your live deal, it could be a potential deal, anything. So about anything we just said. And by the way, thank you for filling out some of you folks. Looks like we got Kevin from Austin, Texas. Welcome, Kevin. We got Tom from El Dorado Hills. Welcome, Tom. We got Mudir from Dallas-Fort Worth, Texas. We got Xavier from Dallas, Texas. We got Rebecca from Truckee, California. Thank you so much for putting that in the comments. So appreciate that. So I'm going to just go in order here. So Kevin, Mr. Kevin from Austin, Texas, any thoughts or questions on anything we just said or about the Deferred Sales Trust?
No specific questions, but I was going to mention that San Diego is a fantastic city. So been there a few different times, but makes a lot of sense. And after our last conversation last week, did a little bit of research, and definitely fascinating on the DST side.
Fantastic. Thanks for chiming in. We'll go down the line to the next person, Mr. Tom from El Dorado Hills. Tom, any questions, thoughts on anything we just talked about, or anything that comes to mind on the Deferred Sales Trust? And no worries if not.
I need to unmute myself, right?
There you are. Yeah, you're in now, Tom. Yeah, thank you.
Sorry about that. So, quick question. I understand that one component of the Deferred Sales Trust is that you basically get a loan, right? That's one of the components. The question that my wife and I have about it is at some point the loan is due, right? So how does that work?
It's a great question. So at some point the loan is due. How does that work? So Jake, do you want to take that question? How would the structure in the note work? What does it look like typically, and what happens if it comes due?
Absolutely. So after doing thousands of trusts, the law firm that authored and originated this strategy 25 years ago has established some best practices of how to get this all working and together. Essentially, should you have an asset, let's say that it's a house. It might be a house that you've lived in, so it's not eligible for a 1031. This is very much like one of Brad's clients that had a house in Palo Alto. And how much did that sell for, Brad?
That was 8.3 million.
And what was the basis?
6 million.
Okay, so he had about a 2.3 with only a $250,000 exclusion because he was single. All right, so 2.3, and essentially what happened was there was a promissory note at closing because there was an exchange that took place. And the exchange was the house in his name transferred to the trust. The trust now, to exchange for that property so that it wouldn't be a taxable event, had to provide a promissory note to the client. So the client, instead of holding physically the house now, is holding a note against the house. He became a lender. He went from being a homeowner to a creditor against the house. And that promissory note, typically, as we've mentioned in prior occasions, oftentimes we set it up for a 10-year period. Now, it can be set up for any period, but again, based on 25 years experience, a 10-year period is a best practice. So we set it up for a 10-year period with a balloon payment at the end, of which we refinance or reset it for another 10, should we go longer. Now, that promissory note with an interest obligation, which depending on the size of the trust, whether it's the 1.0 or the 2.0, we may be making payments on it. We may turn it on, we may turn it off. There's a lot of different ways to go about doing it depending on your needs and the size of the transaction that we're dealing with, right? However, at the end of the day, the structure of the note is, as mentioned, typically a 10-year note with a balloon payment, of which, should we reach those 10 years and we haven't exhausted the funds, we haven't taken in a K1 distribution, we haven't pulled from the principal and extinguished everything, then we reset it for another 10 and we continue to utilize it as a financial tool in conjunction with other tax strategies so that we can continually reinvest.
So Tom, how did that sound? It makes sense? Any questions there? Did that answer your question?
Yeah, primarily, but I did have a follow-up. So let's just say, let's say you drew down, half of that money for whatever reason, right? So let's say you have $4 million left at the end of 10 years. The balloon payment would be, I don't know what it would be in that case. So you'd probably have to help me out. But if you don't have the assets to repay the balloon payment, how does that work?
So again, as an installment note with an interest-only payment with a balloon at the end, should you make additional payments prior to the end of the term, you are decreasing the note itself. Does that make sense? And so if you've taken half of it out, if it was 8.3 and you took 4 out and there's 4.3 left, that would be the amount that you'd be resetting or refinancing moving forward.
Got it. Okay.
Yeah. Another way to put it too, Tom, is you have performance, you have the actual promissory note. And typically, by the way, people might be wondering, like, it's 10 years, but what's the interest rate? Well, 5, 6, 7, or 8, depending on your risk tolerance, right? Now, it's not a guarantee. It's not a promise. We've still got to go make the money. So what's happening over that 10-year term, though, is really the key. That the goal is to net, let's say it's 8% is the risk tolerance, net 8 after the recurring fees, net of the recurring fees. But let's say it only earns 7. Well, in the scenario where if you had 25, 35, 40, 50% in tax that you would have paid anyways, we're already way ahead. Most of our clients will live off interest-only payments, but they'll only take 4, 5, 6% payouts, and they'll keep a little cushion between that and the 8. But even after all of that, if it doesn't quite earn it, then it's still better than you were before, right? That's why we like to have the minimums. So the one thing we always try to focus on is time, right? Time is the one thing we can't get back, and it's the most important aspect of any investment horizon vehicle, right? So how much time? And the cool thing with the deferred sales trust is it can go for 10 years, and then when the balloon payment's coming, you can renew and kick the can for another 10 years, kick the can for another 10 years, and just keep that going, pass it to your kids. And again, hopefully we're out earning the fees as well as the interest rate, and you're only ever having to take the golden eggs, and the golden goose would be the initial principal. And the goal is to not eat the principal up, eat the golden goose that lays the golden eggs, which is the interest payments. Now you might be wondering, well, what do I pay tax on the interest payments? Well, it's a 1099 INT, really simple. You report it to your CPA, and you pay tax on that as ordinary income tax, unless you had partnered with the trust and purchased an investment real estate property. Now, then there's potential, if you're an active investor, to get some depreciation on that asset that could potentially offset that income, which is kind of cool, right? And this is like the tax flow strategy. It's not just cash flow. It's how do we tax engineer and optimize when we receive cash flow to offset it with depreciation. So these are all the things that we like to geek out about, to strategize with, to work on. Tom, does that answer the question or create some more?
One follow-up. If at some point, if the asset or the trust, let's say somebody passes and it needs to go to the heirs, right? What happens with the basis at that point?
Jake, you want to answer that one?
Yeah, so that is one important thing to recognize here. So you're talking about basis, but we're also talking about the loan. So let's touch on the loan first. So typically this trust is a business trust, and it does not eliminate the need to have, a family trust and other things set up. Typically people move that so that it can transfer seamlessly onto their heirs, the promissory note. Now, if you're accustomed to having other assets step up in basis, like if you personally own some stock and your basis is $20 and now the stock is $500, one great benefit to passing away and leaving it to your heirs is that there's a step up in basis for your heirs. However, with this, Brett, based on conversations with the tax attorneys and everybody else, there is not a step up in basis for the promissory note or any type of forgiveness for that deferral. All right. So once it's outside of your estate and it's set up in this business trust, it has kind of a different type of longevity than that of your own life. That also comes with corresponding benefits. So it is true that should somebody pass away, other types of assets do get a step up in basis, and you might be losing that benefit by participating in this deferred sales trust. So if you're an elderly individual and you're thinking of selling or leaving items to your heirs, it might be a different conversation. However, because this is a business trust and it has a different type of longevity other than the natural life of an individual, it does provide a number of advantages based on somebody's circumstances. And so we are able to continually defer those same assets, and their deferral doesn't change, it doesn't reset, it doesn't recalculate. And we're able to.
We might have lost Jake, so I'm going to continue to answer his question. I think he'll be back on. He's somewhere in, I think he's in Mexico today. So we'll come back to Jake when he comes back on. But to answer the question, it all depends, is what I would say. We have DST 1.0 versus DST 2.0. So yes, on DST 1.0, the fact that you're changing the nature, Tom, of an owner to a lender, by nature, to get a stepped up basis means you need to be an owner. So you've exited that ownership and became a lender. So that's DST 1.0. That's the most common deferred sales trust. And then yes, your kids will not get a stepped up basis because there's nothing to step up. It's just it's a loan. Now they can step into your shoes. So the tax is not triggered. They step into your shoes, and on DST 1.0, it is inside of your taxable estate, and they can continue the tax deferral, okay, and pay taxes on the income they receive, or if they cash out, they'll pay capital gains tax. So that's definitely a disadvantage versus a 1031 exchange or another asset that could receive a stepped up basis. Two things to that, though. We don't know that the stepped up basis is going to be around forever. Okay, they talked about taking it away. This even just months ago. It looks like it's staying here for right now. But number two, we have something called a DST 2.0, okay? Now, the DST 2.0 moves it outside of your taxable estate, which completely eliminates the need for not only and also passes to your kids' capital gains tax free, which eliminates the need for a stepped up basis. However, those payments that you receive during your lifetime, it's partial interest payments and partial capital gains tax. So you got to know that you're paying some of that along the way. However, it's outside of your taxable estate, which is really, really remarkable because that eliminates the 40% death tax, which is really the big elephant in the room that most people either are aware of or not sure how to solve. And the tiger by the tail is the capital gains tax. But if you're greater than 22 million married or 12 million single, and all of those equities or all of those assets are inside of your taxable estate, you have more than a stepped up basis issue and a capital gains tax issue. You have an estate tax issue. And so the intent is to get it outside your taxable estate. The challenge is most strategies take a bunch of life insurance, giving it all away to charity, or a bunch of gifting, and they're not very efficient in a time crunch to do it. Whereas the Deferred Sales Trust 2.0, in one single day, in one sale, it needs to be a sale to a third-party legitimate buyer, you can change the nature of ownership and to get it outside of your taxable estate. I know that probably sounds pretty complex. In fact, I have this analogy, and I had this in a Rubik's Cube that I bought off on Amazon a couple weeks ago. And what I like to say, Tom, is when you throw us these questions, it could be a little bit disjointed, right? And everyone's scenario is a little bit different. And our goal is to take this disjointed challenge and try to align these colors as best we can. Now, Jake and I, our brains do go pretty far on this, but we bring in the brain surgeons, the tax attorneys, to specifically do an x-ray on your net worth, on your assets, on everything else. And then the goal is to try to make it congruent on all sides as much as possible with tax flow strategy. That might be more than you bargained for, but Tom, does that answer the question?
Yep, perfect.
Excellent. Great question, by the way. Thank you so much. Does anyone have any follow-up questions for what I just said, or new questions on the Deferred Sales Trust? Unmute yourself, put it in the chat. Would love to answer those right now.
Hi, Brad. This is Eunicia Brad here. This is my second week listening to you guys, and I absolutely love what you have to say. One of the things that I'd love to do is to connect with your team at some point in the near future to just discuss opportunities for us to potentially collaborate, because what we do is we are kind of the go between our clients and the big needs that they have, specifically when it comes to selling businesses or investing the money or minimizing taxes, et cetera, and figuring out what are the most creative and the best ways to do that. And I just love you guys' approach and the way you go about that. So would love to potentially continue that conversation.
Thank you. Yeah, we welcome all professionals. We're in this battle. We actually want those that are passionate and open to working with others in a collaborative way and have a passion for exiting, highly appreciated assets, whether that be business, cryptocurrency, real estate, primary homes, all of the above. So thank you so much. Absolutely. Set a time with me on my calendar. Go to capitalgainstaxers.com and we can get you and Jake. We can all collaborate. Thank you so much for that. Who's next? Who has a question, thought, comment? Well, I'd love for you to unmute yourself. Say hello. This time is for you.
Hey, Brett. It's Rebecca. I had a question. Hi.
Nice to see you.
Can you expand a little bit upon once the funds are in the Deferred Sales Trust, can you expand upon partnering with the trust for, let's say, another project? In my case, like building some more real estate. So, some investment real estate, like fourplexes or something like that.
Absolutely. Thank you, Rebecca. Great question. By the way, Rebecca is one of our strategic alliances. She's a rock star realtor out of the Truckee, Tahoe area. So if you're looking for anyone for luxury or any kind of real estate up there, check out Rebecca. She's amazing, Rebecca Munson. So that is the best kept secret. Honestly, if it wasn't for what I'm about to say to everybody right now, I honestly wouldn't be here. I'm a very entrepreneurial, grew up family, parents in real estate, construction, rentals, cash flow, hands-on, go create some wealth in the Bay Area is where we started out at. It wasn't always easy. Parents got divorced at a young age, and then wealth went to my dad and not to my mom, and I was with my mom most of the time. And I knew at a young age I wanted to have freedom and flexibility to build wealth with whatever I did in life and have a lot of margin. So fast forward, I go to Marcus and Millichap. I learn about the 1031 exchange. I still helping people doing investment real estate, building wealth there. And it was great. I loved it. The 2008 crash hits. Everything hits the fan. And I'm going, oh my gosh, this is tough. Like some lost everything. Some lost half. They had to dig their way out in the next 3 years. It was a mess. And what we found out was that the 1031 exchange at that point was their enemy, in 04, 05, 06, 07, before everything stopped. And the Deferred Sales Trust was their best friend that they didn't know about. And so with that, we said, well, but people want to be able to do their own deals. Like that's how they made their wealth. Like that's how they've done that the last 10, 20, 30 years. Like the Deferred Sales Trust, is that taking that advantage away to be able to go do that? And that entrepreneurial spirit? And the answer is no. And actually you can partner with the trust. And well, what does that mean? Well, Rebecca and her husband, they build houses in Truckee, and then she also sells houses for people. Well, part of what they were doing is they were building, and in a 1031 exchange, remember, it's always equal or greater value, which meant they couldn't buy equal or greater value because it doesn't make sense, right? They bought land and they built and they sold it for a big price. And so they were just paying tax, and then they're walking and doing another one and paying tax. And every single time, especially in California, they're getting hit with about 37 to 40%, just gone. Well, the Deferred Sales Trust, you can sell, not only defer that tax, but you can use that capital to fund your next business venture. So Jake Miller mentioned the cryptocurrency Bitcoin sale for our client who sold $5 million worth into, or exited $5 million into the trust without selling it. She exited it into the trust in exchange for a promissory note. But the next week she partnered with the trust, and for that $5 million, went into a business venture, all tax deferred, no timing restriction, no like-kind requirement, and it gave her the freedom to do what she wanted to do, be an entrepreneur, and use the money that she would have paid of tax to fund that business venture. And so step one is you exit into the Deferred Sales Trust. Step two is you find that business venture of that real estate property, that land to build on, that fourplex to buy. That we have another client who's building 72 multifamily units in Tennessee after his exit. Whatever that business is, just like you would, or that venture is, then you form a brand new LLC. Now you're 100% owner of that LLC, but now you're looking for partners. You're looking for around. You're like, well, who's a partner? And Rebecca might partner with Brett, might partner with Jake or Pierce or somebody else, but Rebecca might also say, you know what? This trust over here owes me this $5 billion. It owes me at 8%. How about this? How about the trust partners with me into this LLC, puts up all of the capital. In this scenario, let's just say it puts up $4 million of capital and goes and buys an apartment complex for $4 million. We'll just keep it simple, all cash. And what's it going to ask for? Well, the trust is going to ask for 20% ownership of that LLC and an 8% preferred return. Now, Rebecca and her husband put no money into that LLC, but why are we able to do that? Well, because they're doing the sweat equity. They found the deal, they're managing the deal, or they're building the property, whatever, and the trust becomes a silent joint venture partner. Okay? And if we do it in that order, you remain tax deferred. So fast forward, what happens? Well, that $4 million, let's say it turns into $8 million over 5 or 10 years, whatever, right? What happens? Well, you got to pay back that original $4 million to the trust, which, by the way, owes you that $4 million typically at 8%. Okay, and you got to pay an 8% preferred on that $4 million, which I like to say it's kind of like borrowing from yourself, but it's not borrowing because if it was borrowing, it'd be taxable. It's a legitimate joint venture. Well, what happens to that additional leftover money? Well, it splits 80-20. Okay. Now that 80, let's say that 80 is 3.5 million, Rebecca. And that scenario, you could just, you and your husband, that's your money, you earned it. You can pay tax on that. But I have an inclination that you're probably going to say, you know what, Brett, can I defer the tax on this too? And we're going to say, you absolutely can. Well, how does that work? Well, you can set a second promissory note and the trust will purchase your position before it sells it to the ultimate buyer. So you'll have one trust, the original at $5 million at 8%, because all the money flowed back in. And then you have the same trust with a second promissory note at about $3.5 million at 8%. So that combined is about $8.5 million. And we call this rinse, wash, repeat. And we go do the same thing over and over again. So did that answer your question?
It did. Yeah, definitely. So,
Great
thank you.
question. All right. Now, I know that was a lot. And Rebecca's heard that about 20 times. Okay. So I know that's probably a lot for everybody else. So there's no bad questions here. This is the most important thing, I believe, and understanding to have the financial freedom, but also location freedom and entrepreneurial freedom that you can do with this trust. So does anybody have any questions on what I just said?
So Brett, I've been getting messages from some people here in the group. And I figure that you're probably the best person to answer this because you've been handling this for 8 years now.
2009 is when I started. Yeah.
Okay.
So I think that's longer, right? What's that now?
Yeah. Well, it's a good amount of years.
That's 13 years. Yeah.
Yeah. So the question is this: outside of the promissory note and the interest rate that's paid out and everything else. Say somebody rolls over $1 million, right? So they got $1 million in a DST and it turns into $3 million. Now, as the trustee, you're managing or facilitating, ensuring that tax returns are done and everything else for the trust, etc. So the question is, hey, based on the internal growth, should, whether it's crypto or whether it's some business entity or whatever, should the value go up substantially? Does the trust pay taxes on that growth above and beyond what was originally put in it?
It's a great question. Yeah. And so the answer is typically it's not a part of it because it's typically operating at a loss. So this is a business trust. And with any business, there's income and there's expenses. Well, guess what the trust is typically, or it is able to do. It's able to expense not only the trustee fees and the financial advising fees and the tax return fees, right? But it's also able to expense what it owes to the note holder, which is, again, 5, 6, 7%, 8%, depending on your risk tolerance, right? And even if it hasn't paid you out yet. So let's do an example. 1 million goes into trust today, and 1 year from now, it earns exactly $100,000, okay, with investments, and fees are about $15,000 to $20,000, okay, on that 1 million, and and you take no distribution from it, okay. Well, the trust is able to expense that 80,000 because that's the 8% that it owes to you, even if it hasn't paid you out, as well as that other amount there. And part of it because it's compounding the day it goes in. It's compounding at 8%. It's building up like this expense runway, right? And what's neat is it's earning, and it's kind of like an IRA or a 401k in this scenario, and that not only is the capital gains tax deferred, but all of the earnings is also deferred. So to the extent that it's now out earning itself on what it owes to you and the expenses, it's not paying tax, okay? And so that is the short answer. Now, here's the second part of this too. It's a 10-year term, right? And so the compounding doesn't stop, right? And if we're able to achieve, in this scenario, let's say we're achieving 12% compounding rate of return from day one, and we're just achieving it. Yeah, at a certain point, there would be some delta there where the trust could pay some tax, but practically speaking, it typically is not. Does that answer the question, Jake?
It does. I guess if we were to complicate the question a little bit further, when you mentioned that there might be some delta, let's say that somebody has a tech company and it literally doubles in 6 months.
Yeah, so in that scenario, like our client, I mean, this could happen. I mean, she just did it a few months back, and let's say it doubles, right? Her 4 million that she put in goes to 8 million. Now, she typically would not realize that until she exited, right? So there's not actually a gain there quite yet. But let's do a whole other scenario. Let's just say she put it in a single stock, although we wouldn't do that on that big of amount. We wouldn't over concentrate, right? But hypothetically, we put it into to 15 different stocks, and Jake does the money management, and all of them just completely, blow up and make 300 or 400% return. It's huge. In that scenario, yeah, there could be some tax there, right? So we want to be aware of that. So hypothetically, yeah, if you make enough and we hit home runs enough, but at the end of the day, that's not it's not a bad thing, because we're doing really well. So does that answer the question, Jake?
Yeah, I think that's good.
Okay. Great question. Who else? Who else has questions for Jake or me on any of what we just talked about there?
I have a question just about building relationships. It's Leah Barraza from Sacramento. I work primarily with residential, but I'm here because I want to grow. And so in regards to like building relationships, who do you suggest that like I can reach out to talk to, and then build referral partnerships with you and Jake and such?
Yeah, great question. Like, how do you grow with the Deferred Sales Trust? And I think you do it as a team, and you do it hyper local. So everybody across the country has different market expertise and also different connections with CPAs, tax professionals, luxury realtors, financial advisors, business brokers, M&A advisors. And when you can go serve them and provide value, what's really cool is they start sending you referrals. I know, Leah, you're in real estate, right? And when you can help, I always say when you can help enough people solve their problems, right? They're going to just send you business, right? Help enough people get what they want, you get everything you want. So that's the key. Like, how do you come and add value to solve problems? I'll give you an example of this. And this took me a while, because when I first started with the Deferred Sales Trust, it was, I'm going to call all the owners in all of Sacramento. And I was in Marcus and Millichap, and they're just going to just jump on. Like, they're going to, like, they got to see it. They got to see it's Netflix. I'm all excited. It's not Blockbuster. We got away. We can save all the stuff. And I had people, hang up on me, call my CPA. If he says yes, let me know. We would call the CPA. We went through months of due diligence. The CPA says yes. Then the client goes, no, I really think you guys would actually say yes to that. And he hangs up. And this guy sold a $30 million deal in Napa. And I just I was crushed. I was like, what? Like, this is Netflix. Like, you told me if we got this guy to say yes, you would do it. We got him to say yes. Like, there was a whole thing of this where I was trying to change the nature of people that were so used to doing something their own way. And I don't blame them. Like, I'm the Marcus and Millichap agent calling them on their properties. Like, I'm not the 30 or 50 or 60 millionaire, right? And I'm telling them about something that they say is too good to be true. They think it is. And now they're going to change their whole philosophy or their whole nature when their professionals aren't bringing it. So I changed my mindset, and I said, you know what? It's not about convincing people or trying to sell them, but it is about finding their trusted professionals and aligning with them and having their trusted professionals bring that, right? Because there's basically a client kind of confidentiality relationship that is not something that can be overnight, microwave. It's a crock pot that takes years to build that trust, especially for the ultra high net worth individual. It's part of why Jake and I love this business, because we get a chance to come alongside those trusted professionals and make them look great and give them a nice referral fee, and then help them to help their clients solve the problem. So that's what I would say for you, Leah. I would say, who is the CPA that you already know, right? Who's the M&A advisor that you already know? Oh, by the way, back to the part I said in the beginning, there's an M&A advisor. Her name is Michelle Charlotte Tucker. She's part of the EXP commercial team with me as well. She joined, but she didn't join because of EXP. She joined partly because I helped her solve a problem on a $55 million deal that she wanted to sell and list, and they had the buyer ready to go, but they had about an $18 million tax, and the seller said, forget it, we're not even going to sell. And so I had Michelle on the podcast, which, if you haven't had a podcast, I encourage you to get a podcast and a YouTube channel, start to talk about these things. And I didn't know about this. I just had her on the show to have her on the show. And as we're talking through the stuff, I tell her what I do, and she goes, oh, that's interesting. I got a business deal. If you can solve this problem, this is like a $2 to $3 million commission for me, and it's going to help the client out. Like, this is a win-win. If you can solve this problem, Brett, I can bring you a lot of business. And so, sure enough, we put in contact. The deal hasn't closed quite yet. It's going to be a huge deal close story of the week. Michelle will be on to tell the whole story. But the point is, we're working through it right now. The clients have listed the property again. There's a buyer under contract, and they're going full steam ahead to use the Deferred Sales Trust. Then I was able to say, hey, why don't you join the team? Why don't you send more referrals? So that's really the key, Leah. Don't sell people. Just align with them and try to solve their problem to help their clients. And also for the people, your clients, if you have those clients, you can absolutely educate as best you can. But really, it's those trusted professionals that can open up their book of business to. Does that make sense, Leah?
Absolutely.
Yeah, Brett, I just wanted to add something, to with that, speaking from a leader's perspective and trying to hammer the people. I thought I was going to come down to Newport Beach and just hammer these super wealthy people with like this amazing strategy, and they were just gonna, and quite a lot like what Brett said, like they just they tell me to just go away. They don't need some 31-year-old kid coming in and telling them that their $100 million portfolio could be better, whatever with our strategy that their trusted advisors don't know about. So I totally changed my entire strategy, and I started farming businesses instead of farming like farms, like people, neighborhoods or whatever. And that's been a lot more effective in trying to get a hold and in touch with these people. It's not like I'm bringing it to them anymore. I'm bringing it to the CPAs and the financial advisors and the tax attorneys, and then they're telling their clients, and then on the back end, I'm hoping that they're going to give me the referrals. So that's kind of how I pivoted. A lot of like what Brett said, but just kind of like, I don't know, saying it a different way, I guess.
Yeah, no, it's really well said. And people don't get overcome. They don't get convinced or persuaded by logic. They get persuaded and maybe they have a change of mind by story. So the other thing I would say too is while you're having these conversations with the client and or the professional, that you're just using story, right? You're saying, let me just tell you a story. Okay. It was a person in Palo Alto. He's the number one realtor in Palo Alto for 30 years. He sells $100 million a year every year. And he is frustrated because he has his house is selling for $8.3 million. He has a $6 million basis. His 6 kids are gone. He wants to move out of California and go to Nevada, like half of the population. But he has his capital gains tax of about $800,000 to $1 million. And he literally can't sell because he has debt of about $6 million and another $1 million capital gains tax, and after closing cost, like he's walking with nothing. And so he finds out about the Deferred Sales Trust, and he thinks it's too good to be true, like because he's been a masterful business person for years in the industry of everything, and he actually sits down and is open-minded enough to learn about it. But not just that, he brings a CPA in to learn about it, and they go through it for months and months and talk with references and clients and the banks and all of this. And he closed the deal and he moved to Nevada, and the realtor was able to get paid, everything. And then this is this quote that he said. He said, Brett, you should take this to every single luxury realtor in the country. This should be what they're telling every single one of their clients. I literally have had sold so much real estate over 30 years in Palo Alto. I can't tell you of probably $100 to $200 million of tax that everyone has paid that they didn't know about this. And so I didn't try to convince somebody to change everything. I just told that story. So I would take this story, rewind this, play it again, rewind it, write it down, put it in your own words, and say, hey, join our mastermind. Come hear these actual stories that are closing. Know that it's a 26-year track record, thousands of closes, billions under management, over a dozen no-change IRS audits, all no cost, no obligation. We don't charge anything unless they close the deal. Just come and be open-minded enough. Does that make sense, Leah?
Yeah, thanks so much, Pierce and Brett and Jake again for putting this on. I mean, like I've said before, if you can hear in other shows that I every time that I'm coming on here, I've been on here for, I don't know, two months now, 3 months, and I can feel my mind literally expanding. I have one of my realtors on here today, and he is like texting me. He's like, I don't really know what they're saying, but and that's the whole point. I said, it's hard to be inside these masterminds. And so for Brett Swarts to be able to give this out to the community like this for free, I'm telling everybody, like, you guys need to understand what's going to be happening soon. There's going to be a shift with blockchain. Big shift.
Thank you, Leah. Thank you so much for that, and keep coming back and keep learning and keep growing here with you. We love that you're part of the community. By the way, I do have a question from Aaron, and Aaron says, "Can you speak to the issue of how you?" And this is on the message board. Can you speak to the issue of how you handle and are taxed on subsequent sales of the new replacement investments that the trust makes? For example, say one of your trust new investments is in stock or anything else that you wish to trade out of again into something else, say 6 months later. Okay, so the flexibility of the Deferred Sales Trust is fantastic in that you can exit what we call optimal timing. It's one of the foundational principles of the Deferred Sales Trust. You don't have to do a 1031 exchange shotgun wedding. In fact, you can sell high and buy low. And there's no replacement requirement. There's no debt replacement requirement. There's no like kind requirement. That's why 1031 is blockbuster. And that's why the Deferred Sales Trust is like Netflix. Okay. So the trust investments can go in between different asset classes. Question is, what's a good time for that? Well, you have the financial advisor, Jake Miller, okay? You have yourself, you have the trustee, and we're going to strategize, okay? And you have to approve of all investments, and I have to approve too because I'm a trustee, right? That's important. You understand that relationship. But as a team, we're going to say, what is a good time to do that? So you could buy a stock today. 6 months from now, it goes very high. You could exit that stock, goes back into the bank account at the trust, okay? Then from there, it could partner with you into a new LLC to go buy investment real estate, or vice versa. You could start with investment real estate. It goes very high. You exit back into the trust. Then we invest into securities, okay? And so it's ebbing and flowing, diversifying, keeping liquidity, diversification. These are all of the ways that the Deferred Sales Trust can help you build that transformational exit plan. Hopefully that answers the question. We are out of time, everybody. So I want to encourage you to invite someone next week to come back next week to check out even last week's talk on YouTube if you weren't here, where we had David Young speak about his experience with the Deferred Sales Trust. He's incredible. He told about how he overcomes some of the false beliefs of it's too good to be true. He's one of the top money managers in the world, worked for PIMCO. So be sure to check that out. As well, check out the new book that's coming out. In fact, David Young's in the book. So is Jake Mueller. So is Kevin Harrington from Shark Tank. It's called Unlocking a Tax Deferral, Building a Tax Deferred Exit Strategy. Basically, it's unlocking a proven playbook for exiting highly appreciated assets. And so it's my book. It's coming out soon. I wish I had it here so I could hold it up, but I don't have it. That being said, thank you everybody for participating, being a part of the Mastermind, and we hope to see you next week. Bye, everybody.